everybody. Welcome to episode 6 of season 2 of Chasing the Vision. I am very excited to have Tim and JT back today. We are talking about valuing restoration companies, which I think is going to be a great discussion to have because there are a lot of different ways to value businesses, and restoration is such a unique industry, the way that we get paid and all the different components of it, how our work works in general. So I think that this will be a great discussion, but I want to throw a curveball in first that I did not warn Tim and JT about first, because everybody in the industry right now is talking about, are you slow? How's it going? How's your business doing this year? So I thought to start this episode, we should do a quick pulse check on the industry and see what you're both hearing. How is the industry doing? What's happening with volume? Is the claim volume down statistically actually affecting revenue and how companies are doing? Is it kind of a split? I'm curious what you both are seeing in the market. So, Tim, I'm going to toss that one to you first.
What a hot topic.
I know.
I was just talking to somebody this morning about this. This client had texted me and said, "Hey, we're really doing pretty well right now this year, but I'm hearing this, from everybody else. What's going on? What's really going on out there?" And I said, this individual had said that she was actually talking to you
Yeah.
recently too. I said, you know what? We're just going to have to do a whole nother webinar on this maybe some other time. But
Yes.
to answer your question directly, Michelle, statistically, yes, the industry is down. We're seeing not crazy amounts, but we're seeing claim volume consistently at lower levels than it has been in the last couple of years. Last year, the tail end of last year was pretty bad, I guess, if you want to use that term. But that doesn't mean people are doing bad. And there's some pretty unique attributes of those companies that are doing well. Sneak maybe preview for my next article that's coming out if you haven't seen it yet, but you'll be getting it in your inbox. But there's definitely things that companies can be and should be doing to keep their business on the up and up. And we've got plenty of clients that are running ahead of projection this year too. So I think it's a mixed bag. I said all in all, there's the industry statistics are showing that things are down, but that doesn't mean you have to have a bad year. There's a lot of opportunity to take advantage of some things that are out there if you're willing to work for it. And that's the operative statement there.
Perfect. Okay, so people need to look out for that article, and Tim, maybe you and I need to do a podcast on it separately because
Sounds
that
like
is
a
such a
plan.
hot topic right now. Everyone's talking about it.
It
So,
is.
JT, from your perspective, what's happening in the M&A space? What are you seeing? What are people talking about when it comes to how companies are doing? It seems like M&A has slowed down a little bit.
Mhm.
Some of the strategics may be struggling a little bit, but what are you seeing from your seat?
Well, generally, there's some uncertainty out there. And Tim, you said it really well. I mean, claim volume is down, whether we attribute that to insurance, the couple of mild winters back to back, what's going on in the industry. People are just getting the opportunity to sharpen their pencils a little bit, right? You set your overhead at a certain level and then you back that off 10, 15%. If claim volume is down in a mild winter, you don't get the storms maybe that you're counting on, it hurts. And so I think people are looking for those extra few percentage points to keep the bottom line propped up. And it has affected sales. We're Tim and I, we swapped notes on this a few days ago. We're not back to where we were in 21, 22, 23. We might not ever be back there again. But
Mhm.
there's still plenty of deals getting done. Yes, Michelle, you're correct. Some of the big buyers are not as hungry as they were. That's a fact. There is some uncertainty out there in the market, and I think people are waiting for the dust to settle a little bit to see where this shakes out.
Yeah. Okay. Perfect. Thank you, gentlemen. Okay.
Yeah.
Appreciate you going off topic with me for a minute. So now we can get into what we were actually here to talk about and how restoration companies are valued, which I suppose is a great segue from JT, filling in what's going on in the M&A space here. So JT, I'll stick with you to start the conversation off on what ultimately goes into how company values are derived, and then Tim will kick it to you.
Well, that's a massive question. It starts with cash flow. There's everybody, any buyer out there. When you start valuing a company, you got to have cash flow, and in the space we call it adjusted EBITDA. That's the fancy term, and so you got to be making money. That's the casual term. So many times we get phone calls saying we're down, numbers are soft this year, but last year, the year before, we were up here. Can we value it where we were? I'd love to say yes to that, but I can't. This industry is pretty dynamic right now, and what it used to be when looking at 3 or 4 years worth of numbers, now we're really looking at 12 to 18 and 24 months worth of numbers. It's just we can't look at 3 to 5 years anymore. Of course, we all want to see the trends, but really the last 12 to 24 months is the most critical. So back to this adjusted EBITDA figure, it's a total financial benefit to the owner of the business and their family. And depending on how deep we want to dive, we can dissect that number a little bit. But it's all the ways an owner benefits financially, not only with standard adjustments like interest, taxes, depreciation, amortization, et cetera, right through their personal expenses, salaries, vehicle payments, meals and entertainment, plane tickets, all those sorts of things. So we could probably really bore listeners with a lot of detail, but in general, that number, adjusted EBITDA, is driving the value of restoration companies.
Perfect. Okay. Tim, anything you want to add to that? And do you think that most of the industry really understands how companies are valued?
No, I don't. To answer the second question, no, I don't. Unfortunately, but rightfully so, right? I mean, we can't expect people who don't have much experience in a certain space to have intimate knowledge without doing, extensive research or talking to a lot of people that have been through it. But I think JT articulated the methodology really well. Ultimately, you're looking at some factor of cash flow to the bottom line. And at the end of the day, if that business can't pay for itself essentially over a series of 3 to 5 years, then whatever asking price is out there or in the minds of the owner or the seller, you're going to have a hard time justifying it, right? I had an interesting conversation with a prospective investor just a couple weeks ago for a client of ours that we work with that is not a restoration contractor, but they are a dual service and manufacturing company. And what they were looking at from an angel investor standpoint was not just what does the business do now, but what can it do in the future with the changes that we're planning to make to it, right? So ultimately, it's about an ROI for a buyer. They're looking to get some significant return better than they could in just letting the money ride in the market. That's why these people exist. But I do think there's largely a misunderstanding of business owners that are out there in the restoration space because they talk to their friends and they say, well, we sold for, or we got entertained offers of, and then fill in the blank, right? This multiple, that multiple, but I'm kind of excited today to talk about what influences that multiple because JT, I think you've always said it, the numbers tell the story. They are what they are. You're not going to change historic numbers today. I mean, you can manipulate things a little bit to justify a position, but at the end of the day, those numbers are what they are. But understanding what the multiple represents as an impact on what the ultimate sale price is, the beauty kind of there is in the eyes of the buyer, really. And they can set that multiple at whatever they think is appropriate, whether they want the business or how bad they want the business.
Yeah.
I'm just smiling a bit because you use the term misconception, and that exists out there in full force. You sit around a bar at for people who are doing that at these trade shows, and they hear that somebody got 6 times or 8 times or 12 times, and then I get a phone call saying I know so and so got 13 times, and I say, well, 13 times of what?
Yeah.
And they say I don't know. Well, let's start there. And every now and again, I get the phone call saying, on Shark Tank, this company got, X millions of dollars and they weren't even making any money. And so some of the conversations I have, I'm starting from a negative position. People have got these ideas in their head and they're really not founded on anything reality based for disaster restoration. And so there are some pretty defined guidelines based on the size and the scope and services offered and those sorts of things. And we'll get to them here in the next half an hour, I'm sure. But it will be fun to talk about. Help clear up some industry misperceptions.
JT, I got to ask this question though. That is most of the time the case, right? Somebody comes to you and said, "Hey, can you sell my business for the same multiple that you sold, or somebody sold somebody
Sure.
else's for?" How often do you see potential sellers come to you and say, "I'd like to sell my business for X," but then you turn around and you find out that it's maybe worth much more than that?
Oh.
Occasionally, it does happen. I'm not into ruining people's day, when I deliver financial information, because one thing that when you value and bring a company to market, I can't value sleepless nights, making payroll, the blood, sweat, and tears, this startup in the kitchen table and your equipment was in the garage. None of that matters to a buyer. That was 10, 15, 20 years ago. What we can value is the story and the number and the cash flow and what it means. We'll get into this, but the predictability of those numbers moving forward. Mm-hmm. And so I think there's enough, we talked about misperceptions. I think there's enough accurate perceptions that anymore, I don't shock too many people one way or the other. Occasionally they're a little surprised and they might have a number in mind and I might be a little lower, a little higher than that, but rarely am I wildly different than what they're thinking. Mm-hmm. And so when it is wildly different, I do like to be on the upside of that, not on the downside. And sometimes the numbers can tell a really complete story, but we'll call it a financial story, but the actual story, and Tim and Michelle, you know this, I call them value drivers, the story that goes behind the numbers, sometimes that's a disaster. And even though financially it may be a 10 or 15 or $20 million business, I have to say currently it's not sellable for these reasons, or it's going to be structured in a way that's not very favorable to that owner. You know, let's say you've got 80% TPA work, and of that 80%, 50 of it is with one TPA. Mm. May not change the value, but it's absolutely going to change the structure. Mm-hmm. So there's a lot that goes into this discussion. It's not, and Tim, you know this as well, it's not a matter of cranking out a few cash flow numbers and adjusted EBITDA, hitting it with 5 to 7 valuation methods, and out pops this magical number. Mm-hmm. That's only part of it. And unfortunately, many people call that an appraisal, and it is not. You've got to back up to the story and understand the story behind generating those numbers. Because if you don't understand the story, the number's really not that accurate.
Okay, perfect. Okay, so really quick touch on the fact you have both touched on this a little bit through different questions that we've talked about so far, but one, is M&A still a hot topic? And two, how have valuations changed in the last few years from when the market maybe was super hot a few years ago to it does look different now. So is M&A still a quote unquote hot topic, and our valuations, how have they changed? So JT, you want to take that one first?
Sure. I will try. Yes, it's still relevant. There's still buyer interest out there has not waned. It's still very hot. What has waned is, with numbers being a little bit soft, there's a contingency of owners out there knowing that they're probably not sellable right now. Mm-hmm. If they were valued up here 2 years ago, now they're down here, and that's not when you want to sell. Mm-hmm. It's like selling a stock. When it starts to come down a little bit, that is not the time to maximize your value. But that being said, all the buyers out there are still hungry. So they're out there dialing for dollars, as I call it. And Tim, you and I get a lot of phone calls, you from your clients, me from the industry, saying, hey, so-and-so approached us. What should I do? They want to see numbers. Should I sign an NDA? They want to back up 5 years and look at, my entire business. What should I tell them? And so I field a lot of questions like that. Healthy level of interest, not as many deals getting done right now, but there are still deals getting done. Structures have changed a little bit, as I mentioned. I think the key component here is, with the changing industry this year and last year, expectations also have to be modified a little bit. And if they're not, there's some owners out there who are sorely disappointed. And if 2024, let's say, and 25, and maybe early into 26, if that's your time to sell, then expectations have to be amended accordingly, or there's going to be some disappointed owners out there.
Yeah. JT, I think using the term expectations is a really good way of describing that. So, Michelle, back to your question about how valuations changed. Scientifically or mathematically, valuation methodology has existed for years. So I don't think that will ever change. How the buyers and the sellers are approaching the scenario or the prospect of selling is definitely different today than it was 3 years ago. You mentioned the industry strategics. A lot of those folks were trying to acquire maybe specific geographic locations, putting dots on a map. Maybe they were trying to acquire leadership skill sets that they didn't have within their organization, or market positions with certain customer bases and things like that. There was a strategic reason why they were doing
Hmm.
it. Um, I've seen, and maybe JT, you can either, corroborate this or not. I've seen more interest with folks that have approaching our clients saying, "Hey, we need to get a deal done.
Mhm.
We're looking for a deal." And that's really interesting to me when you think about private equity money. These folks are not necessarily looking to build businesses for a strategic reason for growth factor, but they're looking to build portfolio value.
Yep.
And they've hired people to go out, and their job is to
Hmm.
find companies to buy.
Hmm.
And trying to get a good deal done is harder today than I think it was 3 or 4 years ago,
Mhm.
because the pool of good candidates is starting to wane.
Yeah.
Yeah, all very accurate. When these private equity firms, when they raise a round of funds, as they call it, it might be 100 million, might be 500 million. There's several that are in the billions. They need to place billions in the market,
Mhm.
which are astronomical figures, and they can't find something to buy. That fund is in danger of going away. People have given them money to invest, and if they can't find good investments for it, they will remove it and give it to other firms who can place it.
Yeah.
So there is a pressure to get that placed in the market. And Tim, you and I are both fielding phone calls from equity firms who are both already in the industry and those who are not
Mhm.
wanting in.
Yeah.
And there is a pressure to get it placed and have that money go to work for them.
Michelle, it's not a bad job now that we think about it, right? I mean, if somebody said, here's a couple $1 billion, go shopping.
Nope. The pressure I would feel out of that though, and to get deals done and yeah, anyway, but yeah.
And not just deals, it's the right deal.
Yeah.
Like
It's got to
Brewster's
be the right
Millions.
deal for everybody.
Wasn't that a Brewster's Millions? Wasn't that the line where he inherited the money and had to spend so much to get the rest of it?
I mean,
Quick,
good
we could,
luck to them. That's a lot of money to push into the industry.
we
So
could
Yeah.
call it Blevins Millions.
Blevins millions, Blevins billions. Turn into a B, billions. Okay, so there are obviously a lot of variables that go into the valuation of a business. What do you think is like the key variable that companies really need to be aware of when it comes to that ultimate valuation? Tim,
Tim, go ahead.
Yeah,
sorry.
I'm going to go to cash flow. Cash flow is
Yeah.
always the number one driver for me. I mean, you can manipulate the numbers and make them look, the ratios look how you want them to look for underwriting purposes or financing purposes, but at the end of the day, cash doesn't lie. And
Mhm.
the companies that produce significant amounts of cash with their operating activities are the ones that sell and sell quickly.
Cash is king. JT,
Cash.
what do you think?
Yeah, that is the number one driver. It's immediately followed by a couple of key story variables, but at the end of the day, you got to be making some money, and if you're not, you default to an asset value,
Mhm.
and those valuations are no fun to deliver. Here's a quick example. Let's say somebody's doing a couple of $1 million in top line sales. They've slipped a little bit there. They've got, let's call it $400,000 of assets. The bulk of that is going to be a vehicle fleet. And the valuation comes along because they're not making any money. There is no multiple to apply to that adjusted earnings or adjusted EBITDA. And what's left, if you can't value a restoration company on its earnings, you default to the balance sheet. So now you start looking at the value of the vehicles, the types of equipment that they have, and what's left. And those are disappointing because you go to those owners and say, you're not making any money. You haven't made any money recently. We can't value it based on where you were 3 years ago because that's not applicable anymore. So your company is worth X.
Mhm.
And you can just feel the air get sucked out of the room. And I know Tim well enough. He doesn't have an agenda. I don't have an agenda. Both of our focus is to put money in these guys' pockets, right?
Mhm.
And I love delivering valuations that are 60, 70, 80 million. Those are the fun kind. You get down into businesses that aren't making any money, it's tough. But you've got to give these owners the reality of what they're facing, which is why we try to dispense reality and get them really good answers for planning purposes. So it's starts with the math and quickly defaults to the story.
JT, that brings up a good point. I just thought,
Mm-hmm.
Michelle, I'm going to go off script for a second, but
Go for it.
maybe dive into the details of the asset value side.
Sure.
In one of the unique things that I've seen is that a lot of buyers, at least that come to our clients, they have no interest in real estate.
Mhm.
Do you think that that might change the dynamic of how they view the value of the assets if they were looking for real estate to go along with the equipment?
Typically, it's a really good question. And when I was doing more SBA deals, which was a few years ago, and I'm not doing so many now, they love the real estate. So did the lender because that was collateral. You
Yeah.
could take a 10-year, let's say it's a $3 million transaction, and it was a 10-year deal. Well, without the real estate.
Hmm.
Well, if you threw the real estate in, now you could do a combined rate,
Hmm.
10-year on the loan, 10-year on the business, 25 on the real estate. Well, now we've got a combined rate of, let's say, 17 years for a real estate payment and the business payment. Oftentimes, your payment only goes up incrementally, sometimes just a few percentage points.
Yeah.
And now you're buying the real estate.
Hmm.
So it's a much better deal. And the bank has extra security. So it's really terrific that way. Most equity firms, most industry strategics, they are not interested in the real estate. They're just not in the real estate business.
Right.
Now, sometimes they'll express interest. And what's very common from my seat is for those owners to give a buyer right of first refusal in 3 years or 5 years. But of course, the owners want to hang onto that too for a revenue stream for the foreseeable future.
Hmm.
So it's always a topic of discussion, but I don't do a lot of real estate either. Maybe 1 out of 10 has real estate attached.
Yeah.
Okay, so that was kind of a good segue into talking about this is a project-based industry, and a lot of restoration companies don't have a lot of assets. We don't have multi-million-dollar pieces of machinery that are going to go with a sale, right? We have some
Mhm.
air movers and some trucks and vans and those kind of things, maybe a building, maybe. So JT, I'm going to toss this one to you first. How do you go about valuing a company that's project-based, especially when there are variables in our industry like
Mhm.
TPAs and getting, a lot of your work from there versus private work that you're getting through maybe through your sales team or
Mm-hmm.
other revenue sources. So how do you value a business with all of these other factors?
Well, it's such an interesting question. When I got into the space in 2007, I started beating the private equity drum, saying, listen, this is recession resistant. It's a great industry. For 5 to 8 years, everybody said, no, 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 we don't want to look at it. It's project based. There's no repeatable, verifiable income.
Mhm.
And my head would explode because we knew there was going to be waterline breaks. We knew there was going to be mold. We knew hailstorms, and we knew the disasters were going to happen. We just didn't know when. Well, it wasn't until COVID happened that then really everybody sat up and took notice because we were deemed an essential industry, right? And so now all of a sudden we were safe investments. But the project base was a real issue for a long time. It's not so much anymore. So if that answers the project-based question,
Mhm.
you've heard me mention, I'll default now to the numbers in the story and why that's important. You mentioned there's only a fractional amount of the value as assets and vehicles and digital equipment, et cetera. That's true. And so companies are valued on their cash flow.
Mhm.
And let's say we have a $20 million business that's sitting on $2.5 million of assets. Well, there's $17.5 million of goodwill there. Well, how do you value that? It's the value is derived from the cash flow. It's the money that's going to be made. And the more predictable that cash flow is, the more stable that valuation becomes. If you've got a company that's growing, let's say 8% a year, year over year over year, 5, 6 years in a row, we know pretty much what next year is going to hold, probably the year following. Now, we're in the restoration space. It's dynamic. It's changing quickly. So it's not a given. But that kind of growth is predictable. That's what buyers want to see. You get these sellers, and much of the industry right now is hurricanes and fires and the hailstorms, and we get these fluctuations in numbers. It makes it very unpredictable, and buyers don't like unpredictability. Buyers are very hesitant to start stroking 10, 15, $20 million checks for numbers that can't be verified and predicted. So there's a tremendous amount of questions that get asked about the types of work, the referral sources, where is it coming from? How long have you been working with them? What does it mean? What are the margins for this different types of work? When were the profit centers started? Oddly enough, I've got several clients now getting into capital improvement work, which is a recent development the last few years. That's new. So the story, because the story makes up so much of that goodwill, there's a lot of value that's put on that story. And I can't and won't underestimate that for the listeners, because it's not all about the numbers. It starts there, but the story quickly has to support the numbers.
Yeah, absolutely. Tim, what's your take on this assets versus cash flow versus all the things with the restoration company?
Yeah, well, I mean, a couple of important things that you said, JT, that I want to highlight. One is, I love your value driver list, because at the end of the day, that's going to dictate whatever the multiple is that somebody's willing to pay for a business. But your point about the predictable and unpredictable nature of the
Mm-hmm.
business, I think there's a couple different ways of looking at that, at least in my eyes. And I used to kind of fall trap to that. Oh my God, this business is just, so unpredictable. There's nothing you can do about it, and the turbulence and all the rest of that stuff.
Mm-hmm.
But at the end of the day, go back to, the project-based theory there that you talked about, Michelle. Um, Short of childbirth and death, crematories and funeral services, nobody's got a guaranteed client base.
Mm-hmm.
And even that's got, subject to some variation too. But this business, I think mathematically at least, is a little bit more predictable than most people give it credit for, because we take the event-driven stuff and we throw it into the equation.
Mm-hmm.
If you were to remove or smooth out the spikes in work that
Mm-hmm.
occur based on events that happen, and you just take a look at the day-to-day business, there is a lot of predictability there. I mean, we have seasons, and this business that we call restoration is driven by weather events for most of the time. The events that you capitalize on that are catastrophe driven or some sort of weather event driven, those are gravy. That's things that you can layer on the top of it. But when you smooth out the peaks and the valleys, and you look at it on a cyclical curve, you can predict what's going on, and you can predict what's going to happen this fall and next spring based on the weather patterns and the science that's out there. All you have to do is plug it into an occasion. So I don't want to kind of get on a long rant about that, but back to what it means for the
Mm-hmm.
valuation of the business. I think there's more value there to this business and less risk than a lot of people gave it credit for in the past.
Mm-hmm.
Hence the reason for your discussions with the PE world. And it's no secret that they want to continue to be interested in buying and investing in this industry, because it is more predictable than we think.
Yeah, and Tim, I think you're spot on. And what it's lending itself to, and you know this better than I do, Tim, is the ability for real-time accurate data.
Mhm.
So when somebody comes along and says, what does our business look like without those two hailstorms, without those six projects that were from the hurricane, without the $600,000 fire job that we had? When you boil it down to bread and butter, people want to understand what their business looks like.
Mhm.
You've heard me say the story, 4 years ago when the northern half of Texas froze. Everyone tripled their business, in a 2 month period. I got 11 or 12 phone calls,
Mhm.
maybe even 13, from people who wanted to sell in Texas.
Yeah.
And nobody buys a business based on one weather event.
Mhm.
It's not going to happen. So that real-time data is critical to figure out, what the business really looks like. And if you can slice the data thin enough, and companies are getting better at it, the software has come a long way the last 8 or 10 years, then you really get an inside look.
Yeah, I'd like to maybe take my hat off to those folks that are in this business that come from the food services and hospitality industries, because they've got that data. They've been using it for years,
Mhm.
right? And you can see people go out to eat on Fridays and Saturdays, and
Mm-hmm.
they eat at specific times of the day. Like, it's very predictable in nature, but you can liken our catastrophe events to the holidays. Mother's Day is like Christmas for restaurants, isn't it? So it's not about the value isn't can you service your customers every single day, really, but can you make your hay whenever the sun's shining? Can you double, triple, quadruple your
Mm-hmm.
servings in one day based on a surge of events that is coming?
Mm-hmm.
Because if you can, and you can do that repeatedly, as you mentioned
Mm-hmm.
before, a lot of times it's not about one snapshot in time, JT, but can you prove that you can do that over and over again
That's right.
consistently? Oh man, you can watch that multiple go from 3 to 7 or plus real quick if you
That's
can.
right.
Yeah.
Yeah.
Okay. Okay, so we've talked about cash is king. We've talked about the story is important, cash flow, those kind of things. So, what are some other key variables and drivers for valuing a company? Tim, I'll toss that one to you first. Other significant variables.
Yeah, well, first of all, you have to be profitable at doing it. I mean, and I think that kind of goes hand in hand with cash flow, but being within the industry benchmarks, within reason, and there is such a thing as, being too high
Hmm.
in the margin side of things, because if you're, burning relationships or having receivable issues, you can charge whatever you want, but if you can't get paid for it, like
Mhm.
profitability and cash flow are two different things in that regard. So you have to, produce within expected levels. I'm always going to come back to owner independence. That's
Mhm.
one thing, and that's going to be kind of in the eyes of the buyer too, but also the seller. Am I buying this business for the owner, or am I buying this business so that I can operate it absent the owner? And you've got to understand your position and
Mhm.
whether or not the business can run independent of the owner or not. But then, I'm sure JT would probably corroborate this, the quality of the customers that you have and the revenue
Mhm.
mix, whether you're a full service company or mitigation or cleaning or whatever service line is, you want an appropriate mix there. You don't want to be too heavy in one area or the other. So those are my big ones.
Mhm.
JT, what's your take on variables, other variables?
It's such an interesting question because there's so many buyers out there right now. The buying market is becoming segmented. I'm actually creating different buckets of buyers for different product and service mixes. We've got those that would rather have mitigation over restoration. We've got those that would rather stick with the daily, bread and butter residential versus the lumpiness of what commercial can turn into. Most want direct and not TPA. Little TPA never hurt, but they'd rather do without it.
Mhm.
Dependency on the owner. Tim mentioned that. That's a big one. You get an owner that's wearing 15 hats and working 80 hours a week, that individual's tough to replace.
Mhm.
Big one for me is a cleanliness of financials. We've talked about that.
Yep.
You can have a very profitable company.
Yep.
And if the answers come back, and I ask a lot of questions because I have to get arms around the numbers. If the answers are, I don't know, we don't track that. Oh, that's in the wrong category. That's in the wrong place. Oh, that was misstated. It should have been last year, but we got the check this year and we just lumped it in here. And if there's enough of those, we've got to clean them up.
Mhm.
Okay. Buyers don't write checks for financials that are not clean. They've got boards to report to and they've got investors to report to. And so that's a big one. And sometimes I deliver news to sellers that say you're sellable, but not right now. We've
Mhm.
got to clean this up. And that's a pretty simple fix. There's enough accountants out there who are specializing in the restoration space. They can come in and help companies get cleaned up. And it's a pretty simple fix. Um, Level of professionalism is a big one. How tight is your paperwork? How many lawsuits have you been in?
Mhm.
It's one thing to say we've had two workers' comp claims the last 5 years. We've never been sued. We've got a couple liens on people's homes to get paid. That's one thing. It's another to say we have 11 workers' comp claims a year. We've got multiple lawsuits. We've got a sexual harassment lawsuit based on a project manager that's no longer here. Where it can be a mess.
Mhm.
If your paperwork's not tight, and that's getting cleaned up over the last 5 to 8 years. So that's a big one. Um,
JT,
you
can we
know,
go there? Can we
yeah,
go there for a second with the red
sure.
flags? Because I hear this often times when I talk to our clients or whoever, and they'll say, I've got an outstanding lawsuit, or I've got,
Hmm.
a claim that's hanging out there. I can't sell right now because I've got this thing, whatever that thing is.
Yeah.
Is it really that big of a deal breaker, or is it more the repetitive,
Mhm.
scenario where you've
It
got a lot of that going on?
Perfect question, and I'm really glad you asked because it has to do with the position of risk and the potential liability for the buyer.
Mm.
If whatever lawsuit is happening, if the buyer is going to take over that business, and I won't get down in the weeds, but now we do a lot of F reorgs and 338H10 elections and where there's new entities created and disregarded entities for liability purposes and those sorts of things. So buyers do all they can to protect themselves. But if they feel there's a liability issue, whether it's from a disgruntled employee, from a client, from a vendor, from somebody who's going to countersue them in the future,
Mhm.
they're if they don't or won't accept an indemnification from the seller says, hey, anything to do with this issue, it's on me. I'll take care of it. Well, sometimes that's acceptable in certain types of lawsuits, and other times it's not. Okay, so it depends. How's that for a perfectly useless economist answer? But it just has to do with potential liability.
Okay. I think you
So
gave me the
liens
answer I was
on,
looking for. It's
yeah,
not a one thing. If you've got
it
a
is not.
lawsuit, if you owe back taxes, it's a done deal, you can't sell your business. The answer is no. Some of those things can be worked through.
Most issues can be worked through. Put it that way.
No,
Yeah, most issues can be worked through. There's very few that will stop a transaction in its tracks.
got it.
Yeah.
Okay.
So anyway, Michelle, there's a short list of 5, 6 variables that are essential to buyers.
Yes. All right. I love it. Okay. So I would imagine there's more than just one key number surrounding the valuation. So what would be other numbers that might kind of go into the valuation process? JT, you want to tackle that one first?
Well, I'll let Tim handle key numbers like gross profit and gross margins, and those all are part of making money. The numbers that I look at that fly below the radar are referral sources.
Mm.
Where are they coming from, and how long have you been worked with them? The tenure of your staff. Quick scenario. Let's say you're a really great manager. You've got a $15 million business. You've got, 7 people on your leadership or management team. They've all been with you for at least 4 years. 5 of the 8 have been with you for 10 years. They've all got a little sliver of equity. Everybody's rowing the same direction, right? Great team for a buyer to step in and buy.
Mm-hmm.
Okay, well, now let's go to company B. Same $15 million company, same financials, but we've got, and this is all hypothetical, we've got an owner that's a micromanager, thinks he's always right, tough to work for, in everybody's business all the time. The average tenure of those 8 employees is 18 months. They're running employees through the front door just faster than they run them out the back. Nobody likes this guy. Relationships are always temporary based on the project managers and estimators out there hustling for work. And so you can see the dichotomy between those two. The numbers are the same, but how we get there is totally different. Mm. And so that employee tenure is vital. Mm-hmm. And when I deliver an analysis, I will say, of the 8 people, you've got a collective 114 years experience. We've got 87 of those have been with you. 2 of them have been with you less than 2 years. One's a new position, so that really doesn't even count. That's just due to growth. So it's eye-opening for some of these owners to look at some numbers that fly beneath the radar. So that's a key one for me. We can get down into plumber referrals versus, TPA versus, internal sales versus external sales. What's repeat, what isn't. Some of those are key, but it all has to do with predictability of the numbers. So I could probably bore the 2 of you and hundreds of others that are listening with lots of key little figures, but in my world, it's all about what happens post-sale. How do we replicate what's been happening in the past?
Sure, that makes sense. Tim, what's your take on this one?
Yeah, I'm with your comment there, JT. I think if we digressed into the actual math behind the numbers and things like that, we'd have a bunch of unsubscribers for this podcast. Maybe that's a chat for another day. But I think the key there, Michelle, is numbers plural, right? If there's certainly operation, we live in an operational metric world. So you're talking gross profits, you're talking direct labor percentages, you're talking, this ratio and that ratio. But at the end of the day, all the sales eventually are going to go through some sort of quality of earnings audit, right? So they're going to hire a bunch of accountants and they're going to slice and dice the numbers, put them where they should be or they need them to be, and then they're going to start running some ratios and they're going to look at trends. And your accounts receivable turnover ratio might be one thing one day, and your cash position might be another thing another day. But taking a look at ratio analysis like that to see, is it going up or is it going down over a period of time? Is it moving in the right direction that I would want it to move? It tells a much greater story of the value of that business than just taking a look at that percentage or that number in a fixed period of time. Companies that buy other companies are looking for healthy organizations generally that are moving their ratios and their trends in the correct direction. If they're moving in the wrong direction, then they're looking to buy it when it's on sale. That's the bottom line. They're looking to turn it around or do something with it. But I think that's a different marketplace than what we typically are discussing here. So hopefully that answered your question.
Yep, it does. Okay, so Tim, I guess I'll toss this one to you first. There might be
Okay.
people listening that are like, hey, I don't plan to sell anytime soon, so why should I get a valuation on my company? What would be the value to me to know what my company's worth today, even if I don't plan to sell right now?
Well, I mean, there's a lot of different reasons, but ultimately, I think the end of the day, every business owner should wake up in the morning and think to themselves, what is my business worth today? Have a firm understanding of what that is. Because if you're not growing it in value, then what are you doing? What are we in business for? There's not a lot of nonprofits in the restoration space, right? So
Yeah.
we have to be growing or increasing the value. But so there's a bunch of different reasons. If you're going to pass the business down, you've got some sort of succession plan in place, or even estate planning reasons. Hopefully, a lot of people are in that position where they've got to do something with their wealth at some point. Financing, raising capital for growth. If you're going to borrow, you have to understand what your business is worth, because they're going to want to capitalize that money against something, or secure it against something. Sometimes insurability plays into the factor there too. So if you're going to have the appropriate levels of insurance for certain areas, you need to know what the business is actually worth. Otherwise, you can over-insure yourself or under-insure yourself.
Mhm.
You don't want to be, playing that game too much. On rare occasion, if you're going to get into bringing a partner into the business, that is critically important, because at that point, that partner needs to know what his share is based on whatever. And just as a side note, the worst partnership arrangements that are out there are 50-50.
Hmm.
We've seen so many issues with those 50, quote unquote 50-50 partnerships. They need to know what percentage they own of what,
Hmm.
and of what is the key. Okay. And then, of course, the worst case scenario would be, if you break up with your partner or your spouse in that point. Um,
And so many of those aren't even documented, Tim. They're handshake deals, and then it's he said, she said, or so they can be rough
They get messy
for sure. Oh yeah.
very quickly.
Yeah. Okay, JT, what are some of the reasons that you think companies should be valued beyond, hey, I'm coming to you, JT, I want to sell my business? What's it?
Well, Tim gave a perfect answer. Tim, if that whole Violand thing doesn't work out, we need you to exit strategies with an answer like that. That's perfect.
JT, I need it to
So
work out.
there you go.
I woke up
No,
Doesn't
I
work
woke up
out.
this morning and said to myself, "What's this place worth?"
that's right. No, it was a perfect answer, Tim, and I can't add too much to that. It's I will say that once you know what it's worth and what's driving it, then keeping a business, getting an exit ready, and keeping it there is a value to anybody. You guys have heard me say this, that once or twice a year I get phone calls from hospital parking lots, and those are rough. Those are rough, and the lack of planning, the lack of willingness to want to understand is astounding to me,
Mhm.
because people will say, "Oh, I met you 4 years ago. I was on a 3 to 5 year plan. I pushed that. I'm now, 2 years out, and now I'm sitting in this parking lot, and the doctor just told me I've got to do something with my business next month. I've got to get out now." And there's everybody's hands are tied. We can't do much. When a business is valued, you understand it. We've got the right people in place. And what I mean by that, Tim, you mentioned in the rare occasion somebody comes in, there's more and more deals, especially in the 10 million and up, that are bringing in owners that have a slice of the pie. They're incentivized with some unit appreciation rights or stock appreciation rights, and they're earning into a percentage of the business. Years ago, I was laughed at for that suggestion, and now it's fairly common. But there's more and more owners bringing in leadership and management to help row that same direction. So when we're talking about share price, it's vital. And when you get there, then understanding how to move that needle every quarter, every year, in upward fashion, and what's going to deteriorate that value, it's really a must, because this industry is dynamic enough. If we don't understand that, it's going to happen to us without us being intentional. It's going to happen, and it's not complicated. It's why Violand and the Tim Hulls of the world exist, is to be intentional with our decision making. And In fact, I just put a quote in an upcoming a little M&A Q&A that things don't naturally spiral into control.
Mm-hmm.
They don't.
Yeah.
And yet we as business owners, we have the capacity to get things to spiral into control. And if a little bit of intention and a few answers and some purposeful decision making, this is not a big mountain to climb, unless you're totally in the bottom of the valley and barely hanging on, which most owners are not. We can get things to spiral into control, and that's a good feeling.
Yeah. Absolutely. All
Yeah.
right. Before we wrap this episode up, I'd love to ask both of you just a few pieces of advice for companies that are thinking about getting evaluation done, for whatever reason that may be. A few key pieces of advice to take with them. JT, I'll kick it to you first.
Well, you've heard my soapbox. I just want owners to make the right decisions, and that's made via answers. You got to have a few answers to make the right decisions. And so people are nervous. Ask nervous. People are afraid. Ask afraid. It's nobody's going to call your baby ugly without a good reason. And if there's something that we don't like, Tim, you tell business owners, we get to put our velvet gloves on and say, listen, we can improve in these certain areas. Let's do it.
Mhm.
And it might be a little painful at the time. Looking back, almost always, and I'll speak for you here as well, Tim, correct me if I'm wrong, they'll say, I should have done this 2 or 3 years ago. Why didn't I? Well, there's a fear factor there, and it's easy enough to get over. Okay. So I think that whole process is kind of like a pre-inspection on a house.
Yeah.
If you're going to sell a house, wouldn't you want to be informed instead of leaving it up to the buyer's inspector to tell us what's wrong?
Yep.
I've always done a pre-inspection. Let me fix what's wrong
Mm-hmm.
beforehand. And we're not talking $2,000, $3,000. We're talking tens or hundreds of thousands of dollars or potentially millions. So let's address it and hit it head on because it's real money. And, I said it earlier, I'll say it again. The outside of asking is just get educated. Use this runway to really understand what we're up against. And if the Tims and the JTs of the world can make your future better, which is what we're both trying to do, it's an exercise definitely worth going down that road. It's there's a lot of money at stake, so let's make good decisions with it.
Yeah. Tim, any final words of wisdom?
Yeah, I would encourage people to just keep an open mind. A lot of people they have an idea, but maybe they don't know intimately what their business might be worth. And I think it goes on both sides. I think there's probably people that are in the ballpark where they think their business is worth maybe more than what it is. And like you said, JT, we have the displeasure of maybe delivering that information from time to time. But I think there's equally as many people over there that undervalue their business too.
Mm-hmm.
And taking into consideration the personal gain or benefit that it brings to the owner financially, and it can be very significant. And I'm surprised at the amount of clients that we work with that are embarrassed by, oh yeah, the business pays this expense or the whatever for me personally. And it's a legitimate legal way
Mm-hmm.
of receiving income or benefit from your business, and they're embarrassed by it. But then they don't take it to the next step and think about the tax savings there. And if they had to earn, a lot of that money as a W-2 employee working for somebody else, how much that money that would cost them.
Mm-hmm.
So there's a lot of misunderstanding there. And I think the biggest piece of advice I could give people would be, just keep an open mind on both sides of the coin there. And you'd be surprised, just like real estate or anything else, a business is worth what somebody's willing to pay for it. And the name of the game there is convincing them to pay what you want for it.
Mm-hmm.
All
Well
right.
said.
All right, gentlemen, great episode. So for people who are listening, you can find all the episodes of Chasing the Vision on the CNR website. Tim and JT also share clips of it on their pages. You can find it on all your favorite podcast platforms under the Restoration Today podcast. And we have some good episodes coming up. So stay tuned. We are going to have a two-parter with a guest talking about deal structure, which I think is going to be a really hot topic. I know people have a lot of questions. I'm sure both of you field many questions around the actual structure of a deal, what it can look like, how creative can we get, what does it really look like, what have other people done? Many questions surrounding that. We are also going to get into family business dynamics, and we're going to have a guest for that one, which is also going to be a great topic. So, gentlemen, thank you so much for this great episode. I look forward to some more in the future.